For the past decade, software was treated as one of the safest growth bets in the market. Then, something broke. By February 2026, JP Morgan estimated that more than $2 trillion had been wiped from software stocks since their September 2025 peak. And then it got worse. The iShares software ETF dropped as much as 35% over 200 days, the fourth largest drawdown in the fund's 25-year history. And it's still playing out. And here's the number that should really get your attention. Forward PE for the software sector went from 84 times during the boom all the way down to 23 times by March 2026, right at the S&P 500 level. By April 2026, it crossed below. Software has always traded at a premium to the broader market. Always. Through every crash, every recession, every rate cycle. That premium is now gone. For the first time in the modern era. Welcome to Uncle Alpha. Today I'm going to give you one tool to evaluate any software stock in the AI age, and one mental model to understand where this market is actually heading. By the end of this video, you'll be able to score any software company's defenses and tell whether it's becoming the AI cockpit or just another feature waiting to be replaced. Quick note. Everything here is for educational purposes only. I'm not a financial advisor, and nothing in this video is investment advice. All investments carry risk. Always do your own research. But first, why is this happening? The answer is deeper than most people think. Most people think software stocks are crashing because AI is going to replace software. That's layer 1, the shallowest take. There are actually 5 layers of fear stacking on top of each other, and each one is harder to dismiss than the last. Layer 1, the tech misread. AI will replace all software. This is what you see in headlines. An AI agent writes code, generates interfaces, handles customer service, so who needs software companies? But this misses something important. AI is a tool. It still needs a cockpit to operate in. We'll come back to that. Layer 2, transition doubt. Even if software won't be replaced, can these companies actually adapt fast enough? History is full of companies that saw the future clearly and still didn't make it. Not because they were wrong, but because they were too slow. Layer 3, business model repricing. Here's where it gets structural. What if one AI agent replaces 3 salespeople? You don't need 3 Salesforce seats anymore. Not because Salesforce broke, because the math changed. Even if the company survives, what happens to revenue per customer? One analyst put it like this. Raise prices 25%, lose 40% of seats, and revenue still drops 25%. That's the scenario keeping SaaS investors up at night. Layer 4, budget siphon. What if the problem isn't company performance, but budget allocation? This one hits everyone, not just weak companies. Look at 2 numbers. The big 4 hyperscalers, Amazon, Microsoft, Google, Meta, plan to spend $725 billion in 2026. Most of it on AI infrastructure. That's a 77% jump in 1 year. Meanwhile, Redpoint's March 2026 CIO survey found that 45% of new AI spending is coming directly from existing software budgets, reallocated, not added on top. So the pie isn't getting bigger, it's just being resliced. And in the short term, that shift has a cost. Layer 5, valuation regime collapse. This is the deepest fear. Software used to trade at a permanent premium to the market. Forward PE for the sector has gone from 84 times during the boom to 23 times by March 2026. What if this time it doesn't come back? And that's why even the strongest software companies are down 20 to 30%. It's not just about whether they'll survive, it's about whether the market will ever pay the old premiums again. 5 layers of fear. Some are real, some are exaggerated, and some depend entirely on which company you're looking at. So how do you tell the difference? That's where our tool comes in. I call it the 4 Moats score. 4 dimensions, each scored out of 10, total out of 40. The higher the score, the stronger the defense. But before we score, there's a question most retail investors skip, and getting it wrong leads to bad analysis. Before you score, who pays? Some software companies have one type of customer. Most don't. They serve enterprises, mid-market, and individual users. And the moat is completely different at each tier. The rule is simple. If a company's revenue is concentrated in one customer type, score the company as a whole. If revenue is split across very different customer types, score each tier separately. For example, ServiceNow gets over 90% of its revenue from large enterprises. We score the company as a whole. Figma gets 64% of revenue from a tiny enterprise tier, and 36% from hundreds of thousands of small teams paying $73 a year. We have to score each tier separately because they face completely different threats. You'll see why this matters in a minute. The 4 dimensions. Dimension 1. Switching cost. How long will it take a customer to rip out this software and replace it? If the answer is 12 months and it disrupts core business, that's a 10. If they can export their files and leave in a weekend, that's a 2. Dimension 2. Data moat. Does this company sit on data that AI can't easily replicate? The strongest moats come from network effect data. Data that gets more valuable as more people use the platform. The weakest moats sit on data that's publicly available. A 9 means workflow data that gets richer with every customer. A 3 means data anyone can scrape from the open web. Dimension 3. AI readiness. Is the company's AI product making customers willing to pay more? That's offensive AI. It creates new value. Or is it just preventing them from leaving? That's defensive AI. It delays churn but doesn't grow revenue. A 9 means customers paying more because of AI. A 3 means AI is just slowing the bleeding. Dimension 4. Capital firepower. AI is an arms race. Can this company keep spending on talent, compute, acquisitions without running out of cash? A 9 means free cash flow strong enough to outspend competitors. A 3 means cash burn with limited runway. I'm using 3 companies as case studies to demonstrate this framework. This is not a buy or sell recommendation. Let me show you how the analysis works so you can apply it yourself. ServiceNow, score 37 out of 40. Customer mix, heavily concentrated. Over 90% of revenue comes from large enterprises. Score as a whole. ServiceNow manages IT workflows, HR processes, and customer service for large enterprises. Their Q1 2026, just reported in April, revenue hit $3.77 billion, up 22%. Their AI product, Now Assist, keeps accelerating. Customers spending over $1 million on it grew 130% year over year. Switching cost, 10 out of 10. It takes enterprises 12 to 24 months to migrate off ServiceNow. Their contracted future revenue hit $12.64 billion, up 22%. Nobody's leaving. Data mode, 9. They process 80 billion workflows and $6.4 trillion in transactions across their platform. That's organizational context no general AI model has access to. AI strategy, 9. Now Assist isn't just a chatbot. They've branded themselves as the AI control tower, orchestrating AI agents from any vendor inside their platform. They partnered with Anthropic to embed Claude directly. Capital, 9. Free cash flow margin at 44%. Extraordinary at this scale. $5 billion buyback authorized. This company has money to burn. Score 37 out of 40. The strongest defense in the sector. Now here's the lesson. On April 22, 2026, the day they reported these numbers, ServiceNow stock dropped 17%. Beat every metric. Raised guidance. Still dropped 17%. Not because of them, because of the sector. That's layers 4 and 5 in real time. Even the strongest moat doesn't shield the company from a sector-wide repricing. Which brings up something important about this whole framework. A moat score and a stock score are not the same thing. Business quality tells you what a company can defend. Valuation tells you what you're paying for that defense. Two completely different questions, and the 4 moat score only answers the first one. Salesforce, score 31 out of 40. Customer mix, still concentrated on enterprises with growing mid-market exposure. Score as a whole. Salesforce's most recent quarter reported in February 2026. Revenue hit $11.2 billion, up 12%. But the headline number is Agentforce, their AI agent platform, which reached $800 million in annual recurring revenue. That's a 169% jump. A year ago, Agentforce was just a concept. Now it's doing 29,000 deals per quarter, with over 60% coming from existing customers expanding. That's real traction. But here's the tension. Strip out the Informatica acquisition and Salesforce organic growth is about 8 to 9%. Compare that to ServiceNow's 22%. Agentforce is growing fast, but is still roughly 2% of total revenue. The old business is slowing down, and the new business hasn't scaled enough to compensate. And here's the question that decides dimension 3. AI readiness. Is Agentforce becoming a new revenue engine, expanding what customers pay? Or is it a retention tool, slowing the seat erosion from layer 3? The 60% expansion rate hints at offense. The 2% revenue share means defense is still doing the heavy lifting. That's why Salesforce gets an 8, not a 9. Score 31 out of 40. Proved it can compete, but the gap with ServiceNow is still real. Figma, the 2-tier case. This is where the customer mix question earns its keep. Based on Figma's 2025 IPO data, only 2.5% of customers generated 64% of revenue. 1 year later, the paid customer base has grown 54% to about 690,000. But the structure is essentially the same. 97% are still small teams paying an average of $73 a year. These aren't the same business. They face completely different threats. So we score Figma twice. Figma Enterprise Tier. Score around 30 out of 40. These are large companies with deep design systems. As of Q1 2026, Figma reports 139% net dollar retention at the company level, its highest in more than 2 years. That means existing customers are paying 39% more this year than last, even before counting any new customers. That's ServiceNow level stickiness. For them, Figma is becoming the operating system of design, embedded, hard to rip out, full of organizational context that AI can't easily replicate. Figma Small Team Tier. Score around 14 out of 40. These users have no design systems, no switching cost, no organizational context, just a tool they pay $73 a year for. Same company, 2 completely different modes. And here's why it matters. Over a 90-day window, 2 AI labs attacked Figma, but they didn't attack the same tier. March 18, 2026. Figma launched its AI credit monetization, the first real attempt to turn AI usage into revenue. The next day, March 19th, Google released Stitch, free, voice-controlled, integrated with Workspace. Figma dropped 12% in 2 days. April 17th, 2026, Anthropic launched Claude Design, a chat-based competitor that turns text prompts into working prototypes. Another 7% drop. By April 30th, 2026, Figma hit fresh 52-week lows, down nearly 90% from its post-IPO peak. Stitch attacks the small team tier, the 14 out of 40 side. Free is hard to beat for a $73 customer with no switching cost. Claude Design attacks the enterprise tier, the 30 out of 40 side. It's slower. Enterprise customers don't switch overnight, but over years, this is the more serious threat. Then came the earnings report. May 14th, 2026, Figma reported Q1 results. Revenue accelerated to 46% year-over-year growth. Net dollar retention hit 139%, a 2-year high. Pro team conversions jumped more than 150%. The company raised full-year guidance and lifted operating margin to 9%. The stock jumped nearly 13% in after-hours trading. But here's what those numbers don't yet show. Q1 ended March 31st. That's 12 days into the Stitch attack and 4 full weeks before Claude Design even launched. The headline numbers reflect the world before either attack landed at scale. And here's the tension that matters for any SaaS investor. Financial data is quarterly and backward-looking. Stock prices are real-time and forward-looking. The market has already priced in roughly a 45% year-to-date drop. The earnings just confirmed the past was fine. Q2 is when we find out if either mode actually holds. Without that opening question, you'd score Figma as a single number, somewhere around 22 out of 40, and miss the entire story. Different attackers, different tiers, different modes, all inside one stock ticker. And Q2 will tell us which evaluation was right, the framework or the market. The 4-mode score tells you which companies are defensible. But that was about scoring. The next question is what they're defending against. What does AI actually replace? And what does it leave alone? Here's how I think about the long game. AI is the engine. Software companies are the cockpit. Think about a modern aircraft. The engine is what gets you off the ground. Extraordinary power, decades of engineering. But an engine alone doesn't fly anywhere. You need a cockpit. Instruments, controls, flight plans. So cockpit is where raw engine power becomes a specific thing, getting passengers from New York to Tokyo, on schedule, safely. AI is the same. It's an extraordinary engine, but it doesn't know your IT department's approval workflow. It doesn't know your sales team's playbook. It doesn't know your design system's history. So cockpit is where AI's general intelligence meets your specific job, your data, your organization. Here's a pattern that repeats throughout technology history. New tools can demonstrate a capability, but winning the market is a different problem. It requires turning capability into something people actually use every day. Take translation as a smaller example. Claude and GPT can translate a financial document better than Google Translate ever could. But professional translation tools like DeepL still exist because they wrap that raw AI capability into the specific workflow professionals need. The same logic applies everywhere. ServiceNow wraps AI into IT workflow management. Salesforce wraps it into customer relationships. The companies that survive, not the ones that ignore AI, not the ones replaced by AI, the ones that becomes a cockpit. Here's a connection back to our tool. A real cockpit always scores high on the first 2 dimensions, switching cost and data mode, because that's what cockpits are, deep integration into a workflow, holding data and context that AI doesn't have access to. If a company scores low on switching cost and data mode, it's probably not a cockpit. It's a feature riding on top of an engine. And features get replaced when the engine gets better. That's why ServiceNow scores 37. It's a cockpit. That's why Figma's small team tier scores 14. It's a feature. The mental model and the score are saying the same thing, just from different angles. So let me be honest about what this framework can and can't do. It can help you evaluate individual companies. But remember layers 4 and 5, budget siphon and valuation collapse. Those affect the entire sector. Remember what happened to ServiceNow on April 22nd, 2026? Best moat in the sector, beat every metric, still dropped 17%. And Figma on May 14th, 2026, big beat, raised guidance, stock popped after hours, still down roughly 45% for the year. Same lesson, two angles. Business quality and stock price answer different questions on different timelines. For context, software's 4 biggest crashes took between 3 months and 5 years to fully recover. COVID was a panic, down 29%, recovered in 3 months. The dot-com bust was structural, down 63%, took 5 years. This current sell-off is somewhere in between. How long recovery takes depends on whether this is a panic overshoot or a structural repricing. The framework won't answer that for the whole sector, but it can help you figure out which companies are likely to recover first. Some people ask, what if AI gets so powerful it replaces everything? Not just the small team tools, but the ServiceNows. In practice, full replacement requires multiple systems to change at the same time. Data sovereignty laws, organizational politics, legal accountability, hardware capabilities, monopoly risk. Each one moves on a completely different timeline. Technology might break through in 5 years. Regulations might take 20. Organizational politics might never converge. The more likely future, AI sits on top of specialized software, orchestrating workflows across systems. Each system still manages its own domain. ServiceNow is already calling itself the AI control tower. That's not about doing everything. It's about being the place where everything connects. So here's what I challenge you to do. Pick a software company you know, one you use at work, or one you're thinking about investing in. First, look at who pays. Is the customer mix concentrated or split across very different tiers? Then score the 4 modes. If the customer mix is split, score each tier separately. Finally, ask the Cockpit question. Does this company hold data and context that AI doesn't have? Or is it a feature waiting to be replaced? Then drop your score in the comments. I'll go through them and we can discuss. Just remember, this is an analysis framework, not investment advice. No framework is perfect. Use it as a starting point for your own research. I'm Uncle Alpha. See you next time.